Good, thank you. I was wondering about that since we're having the actuarial report. All right, we have to have a motion to approve or to accept the absences of Sharif Mansouri as well as Pepe Finn. They both gave adequate prior notice to both me and to Rachel.
So moved.
Second.
All in favor?
Aye.
Okay, that's done. First item of business at this point is approval of the minutes of the April 23rd meeting.
So moved.
Second.
All those in favor?
Aye.
There will be an item that we discuss at the April 23rd. Matter of fact, let me say approval of the minutes of the closed session of the April 23rd meeting as well.
So moved.
Second.
All in favor?
Aye.
No, as I was about to say, there was an item that we discussed in closed session concerning one retiree. We're going to have a very, very brief closed session to give you chapter 2 on that retiree. But since we discussed it in closed session previously, it's appropriate, I think, John, for us to discuss in closed session at this meeting, even though it's innocuous and doesn't pertain to any investment matter that our friends at ACG really need to be aware of. Okay, let's talk about civilian requests.
Move to approve the civilian request for retirement benefits. Second.
All those in favor?
Aye.
We few, we happy few.
Yes.
I think that those are the words. Thank you, Henry. And
Band of brothers.
we, yes. We band of brothers, that's correct. Paul and I went to the same high school, so we probably have the same English course for the most part. So we're trying to remember what we were taught. The police requests.
Make a motion to approve.
Second.
Request.
All those in favor?
Aye.
Done. Beneficiary applications for death benefits, civilian requests.
So moved.
Second.
All those in favor?
Aye.
Rachel, you keeping up on who's first and second? Okay. And the request for, unfortunately, death benefits among the police? No, police requests, that's good. All right, we have one request from a civilian who was with the county and is now with the state of Missouri. That civilian would like to have his pension transferred from the county to the state of Missouri's Mosher's Fund. Can I have a motion to approve?
So moved.
Second.
All those in favor?
Aye.
Done. Okay, Paul, here we are, man of the year.
Let's vote on that when I'm done.
Unfortunately, your numbers don't come up right, but that's not really your fault.
Well, since we're quoting literary people today, it's the best of times, it's the worst of times, right? So
That's right.
the best of the times is the fact that we're talking about this in May, right? So normally the last few years, we struggle getting data. And so it's been July, August, September before we've been talking.
Yeah.
This year, Becky, Rachel, and the team have just done a great job getting the data to me. And so because of this, I think we had this done. I think it's dated the end of April or something. So kudos to them. The problem is that's where the good news ends. So there's some bad news in here. Let me just be upfront. It's totally explainable. It should have been foreseen, but we can talk about that. And there's some things we can do and need to do going forward. But let's just talk through it. So if you'll join me, I think you all have a copy of this in your packet. If you'll join me on page 5. Just
Excuse me, our friends from ACG, do you have copies of this?
They
as
do.
well? Okay, fine.
Who thinks?
All right.
So you join me on
You've
page
got to make up for what where we're deficient. That's your job. All right, go ahead.
So page 5 here, just a brief summary of everything in this report. And so you can see here in the table in the middle of the page, on the right-hand side is last year's number. We're recommending a contribution of just shy of $53 million. And in the middle is the 2026 valuation result. We're making a recommendation of about $60.5 million, an increase of almost $8 million, $7.5 million. And you're just like, oh, we didn't have enough money last year. How do we deal with it this year? I don't know, but why do we have this increase is really what we're gonna talk about today,
Yeah.
okay? There's two primary drivers. Some of the wording at the bottom will explain that, but if there's details in here, I can point directly to you to show you that there's two primary drivers of why this is going up $7.5 million. The first is investment returns, okay? Everybody in the world had a bad 2022. You have a smoothing policy that recognizes those losses over a period of time. And so this is the last year of taking a hit from 2022. So that was really expected, should have been known in advance.
We can only pray that another 2022 does not occur.
And we'll talk about that. Yes, that we don't, but the good news is now we've got a market value that's higher than our actuarial value. We've got gains so there is potential for good news next year. The other big driver that took this, I think the primary driver, I think about $4 million of this was the pay increases that were given to staff as part of the whole, let's catch everybody up on their pay and make things competitive, that market adjustment last year. You can see in the notes down at the bottom, we expect an active who was in the 2025 val, comes back in the 2026 val. We expect on average those actives pays are going to increase about 5%. Instead, we saw 20.4%. And so because of that one event really driving it, pays went up much higher than expected. And because of that, there's a resulting impact on the pension benefit that's tied to those pays. Okay,
Tell me again, how the 20.5% you said, or 24.5?
20.4, 20,
The number you,
20.5.
20.5.
Yeah.
What was the cause of that?
So primarily, I mean, part of it is just inflation and people continuing to work. But you remember last year, there was a huge market adjustment trying to catch people's pay up to what the market would allow. And so because of that, people are getting, Rachel, I mean, they were getting 20, 30% increases all at once. And because of that, their pension benefits are expected to increase as well.
Was that civilian as well as police?
Yes.
Yeah, the family service pay plan.
And probably a significant portion of those individuals are not contributory members of the pension plan.
Quite likely. Certainly the ones with the larger liabilities. That's true.
Yeah. Okay.
All right.
Okay. So let that settle for a minute. And we can turn to the next page, which I know every year is boring, but just so we're clear. This
What
is
page are
talking-
you now?
I'm on page 6.
6, yes.
I like to go over this just so if anybody has any concerns or, hey, I thought this was gonna change, we can talk about it. But this is basically telling you I'm reflecting no benefit changes. There was nothing past that changed benefits going to participants. Also, there was no assumption changes. I'm using the exact same assumptions that I did last year. Really, the only changes that are going into this are updated assets and updated member data. Okay, so if anybody has concerns about that, let me know.
But
But
I want to go back to what Scott just said. The number of individuals are non-contributory. Is that because they were in the original plan? Because the plan
Right.
B, they are contributories.
so everybody's contributory after 2017 or something?
2018, I was thinking. So if you're hired after 2018, like me, you are adding and contributing. That's what the 5 million offset over here represents,
Yeah,
right?
I think my predecessor, Tom Wright, had something to do with that on behalf of the board.
Okay.
As I recall, when Tom went to the county executive at that time, who would that have been?
Stanger.
Stinger. I think Tom made the case very strongly at first that there should be some change.
Sure.
That was rejected at first. It was accepted finally because the numbers are inescapable. And so that's why we have a split
Right.
between the two. I think that was,
And
Tom was still chair at that time. I became chair in 2018, I think, or something like that.
theoretically, as people retire, right, and then new people come on.
Yeah.
The new people are contributing and the retirees who the previous or the employees who were before, who were never contributing, right? Their pension is going to remain the same and the contributories are a slightly different calculation. So.
Gotcha.
Oh, so let's move on to page 7 here, okay? Getting into the numbers pages, I'm not going to talk about every number. just want to highlight a few things. So starting at the top, you can see participant data, head counts. Head counts are pretty stable, especially when you look at that top line of about 3,700 active members. So no surprises there, no big changes. I wouldn't have expected much. You go right under that, you can see our projected annual payroll. Last year was about $250 million. This year it's $290 million, tying again to that increase in everybody's pay to make them market appropriate. You go to the middle of the page, there's a section called assets. Okay, so here you can see year over year, the market value went up about $90 million. So that was a great year. But if you look above it, you see something called the actuarial value. That's where we're smoothing those investment gains and losses. It changed by $500,000. Thankfully, it was 500,000 toward the positive, but still, it's smoothing out the gains and losses so you don't have big spikes from year to year in your contribution. But there was a big loss from 2022 that we've been recognizing. And so now that we fully recognized it, hopefully this $905 million should be going up going forward. Okay. Go to the next page. What is this? Page 8. Again, lots of numbers, but I'm really going to draw your attention to the middle of the page, right above where it says actuarial present value of accrued benefits.
Right.
You've got something called the unfunded actuarial accrued liability right above it. So people have earned benefits over time. You've set aside assets for that. I come in and sort of measure what the liabilities are, compare that to the assets and say, hey, have you collected enough or are you in a hole? You're in a hole. That's what the unfunded actuarial liability is. Last year it was 356 million. This year it's 423 million. Again, it's the compound effect of the investment losses, recognizing that, and the pay is going up and all the other experience, but that was pretty minor. Okay, so Vinny, if we're joking that you've got to make this up, you got to make up $400 million. Okay, no big deal. Okay, go below that, you then look at
Personally.
I'll take the check this afternoon.
Yeah. So if you go below that, you get to the funded ratios. Okay, that can trigger some of the things we're concerned about. So the primary one that I'm looking at is the first one called the AVA over the AL. So last year that was just shy of 72%. This year it's at 68%. This is not a surprise, at least to me. We've been smoothing those assets. We expect that funded ratio to go down until we fully recognize those losses. Okay, so I would like to say that 68 is our bottom, and now we're just working up, but I don't control all the levers, right? So right below that is things based on a market value. So this is something that the accountants are worried about when they're disclosing things in the county's financial statements. So from that perspective, that extra, $90 million we got on a market value basis is working out great. We went up from 69% to almost 73%. So
It's
the money we have is working us in the right direction.
the right direction, but not at the right velocity. Scott, do you think the county council has any idea of what to expect here?
I don't know. I'm not involved really at that level.
Okay. It will likely be a surprise in that case.
And I have no doubt, and we can talk about this, but something we've tried to talk about over the years is just preparing forecasts so you can sort of see these impacts and what the steps, whether it be just a 1-year forecast for budgeting purposes or a 5-year, so they can plan that out. But
Another question I have, I'm directing it to you, Scott, because I don't know who else to direct it to.
Sure.
The county's bonds and the disclosure statements that go along with the issuance of new bonds, does it simply quote the actuarial value of the pension plan, or does it also quote the market value of the pension plan?
Levon actually would be able to answer that possibly better than I can as the chief accounting officer.
Lamont, did you hear my question?
I heard the question. It bears repeating. Can you repeat that question?
Yeah, when the county goes out with a new bond issue, it obviously has to cite or disclose what the actuarial value of the pension plan is, or let's say the funded ratio of the pension plan on an actuarial basis. Does it also disclose what the funded ratio is of the pension plan on a market value basis, or just actuarial?
You know what? I'm not sure, but I will get you an answer to that very, very soon. Does that satisfy?
Yeah,
the request?
That's why it's fine. We can't do anything about it in any of it. It is what it is. But I would like to know, and as we have discussions in the future, I think we ought to just have that in the back of our mind. And when we communicate things to the county executive and the county council, we want to make certain they understand that there are two numbers.
And to be honest, I mean, the information included in the financials, according to GASB accounting rules, would be based on the market value. So I would tend to think Levon's gonna come back and tell you that it's based on the market value, but I'll let him support that. Okay?
The FASB for government entities, is that what that is?
Yeah, Government Accounting Standards Board.
Okay, fine. And it does require market value
Yes, sir.
actuarial funded ratio, market value funded
Yep,
ratio.
it's looking at everything using exactly what's in the trust at the end of the year.
At least it looks better than where we are.
This time.
Okay,
Okay, yep, let's move on then to page 9. Again, more details into how we came to this number. There's really 3 components that go into a contribution itself, okay? First thing's called a normal cost. That's the value of the service people are earning during the year. So if Paul's working during 2026 and gets a year of service, I'm setting aside some money for that year of service. So we do that for every active employee. That's what the normal cost is covering. We're allowing for administrative expenses just to recoup those. Then the third item is the payment to amortize that $400 million unfunded, okay? And so we're recognizing about $40 million this year in our contribution just to pay down that $400 million unfunded liability. We've got a schedule, we're sticking to that. It's just the schedule is quite long. If you go in a couple pages, you'll see that our shortest amortization that we're looking at is 18 years. And so it's going to be quite a long time as we work out of this hole based on the current methods that we have in place. Okay, so you add those 3 things up, you get about $66 million. You offset it for the member contributions that we talked about, and that's where we end up at about $60.5 million for 2026.
and that's 16.5 versus 53 million. What percentage increase is that? You have your calculator handy? Anybody have a calculator or iPhone handy? Just curious what percentage increase is that?
Between 15 and 20.
Yeah.
7 over
16.
7 over
Or 8
53.
on 60.
13 and such percent, so round up to 14% difference.
Okay. Gonna be sticker shock,
Mhm.
but the numbers are what they are.
Yeah.
Okay.
And you'll remember, Milt, I mean, we had the same kind of issue last year. I think we went from 48 to 53. So
Yeah.
these increases last year was tied entirely to the investment losses, but now we've got another compounding thing. There are things that we can see coming that are driving this to go up that could be reflected in budgets. I think the good thing is at this point, we're going to tell you that the 60.5, sort of like the funded status should be a low. I think the 60.5 should be a high as far as the contribution. I wouldn't expect it to necessarily increase next year, but we've got ways of sort of estimating that and figuring it out in advance. Okay. Let's see, we've got more details in here. If you go to page 11, we take these results that we just talked about in total and split it out between the civilian and police plans. No surprises here. The civilian is
Oh, I'm
still,
gonna stop you again. I'm sorry.
yes, sir.
Is it mandated to calculate the payment required to amortize the unfunded liability? Is that mandated to be based on actuarial value of the assets as opposed to market value?
Not to my knowledge.
We
Not
choose
not
to,
county statute, no.
okay, we choose to use the actuarial value for calculating what the increase in contribution.
Yeah, so I think what you're saying is, hey, is there a way to lower this number?
Yes.
Could we switch to the market value? Yes, it can be done, but then that cushion that you're sort of been setting aside of gains that we're going to recognize in the future, that's gone. So if the market collapses and Finney comes back and says, you know what, we lost money, then this could go up next year simply because we'd have to start recognizing those losses.
Well, the board has no authority over that policy whatsoever.
Sure.
But that is something that the county is going to have to come to grips with. What are you going to use?
Yeah. I would assume that actuarial is going to give a greater smoothing effect and have less volatility
Yes,
to budget impact.
yes, it just depends on what you,
So
And stability over time.
what you
Your
want.
approach will lower the contribution, but over a longer term, it will create more volatility.
Well, as I said, that's not for the board to decide. That is a policy decision that the chief financial office has to decide with the county executive and the county council.
Mhm.
All right,
Okay?
bueno.
Go to page 11. Again, we've been talking about the results in total. Page 11 gives some details on how that breaks out between the civilian and the police plans. So I don't know that there's a whole lot to talk about here. The civilian plan continues to be slightly higher, well, not slightly, continues to be higher on a funded ratio than the police plan,
Mhm.
just due to things we've talked about in the past with lags and police catch up and those kind of things. But there is a breakout here. The police does have a larger percentage of unfunded liability per capita. And so you can see at the very bottom, the portion of their contribution as percent of payroll then is higher for the police too, because they're digging out of a bigger hole.
But again, to point out the numbers, the police plan has a funded ratio on an actuarial basis of 59 or 58.9%,
Yes, sir.
whereas the civilian plan has a funded ratio on an actuarial basis of 72.8.
That's exactly right.
And if
Okay.
anybody is interested, I don't know, John, you may be interested, and Scott, you may have already provided that to you. I asked our prior actuarial consulting firm in 2017, I think I asked them, why was there such a difference between the funded ratio of the police plan versus the versus civilian plan? And they went back to 2005, at which point the two plans were about the same. But from 2005 to 2017, they began to move in different directions for a whole bunch of different reasons. And I'm happy to share that memo. Matter of fact, it's in our file someplace, but I'm happy to share that memo. For different reasons, they diverge. And the divergence is really fairly substantial at this point. But at one time, they were about the same. But the police plan, the civilian plan always had, over that period of time, a larger and increasing funded ratio versus the police plan.
Okay.
Yep.
Let's go to 16 real quick. Just so you can sort of see that history note you were just talking about. We've got, this is just historical information, nothing really new here, but it shows you there, if you look at the funded, yes, sir. If you look at the funded ratio column there in the middle of the page, you can sort of see that civilian plan has increased over time, and then with investment losses has lost some ground over time. Same with the police, but you can see there's a lot of sevens starting the civilian numbers. There's a lot of sixes starting the police numbers. So over a 10-year period, the funded status hasn't dramatically changed a whole lot. Part of that's just due to experience. Part of it's due to the fact that we're amortizing things over 25, 30 years. And so it just is going to take a long time for the momentum to catch up. Okay.
Yeah.
Last thing to talk about, page 18. Everyone loves to talk about assumptions. Let's talk about them real quick. Like I said, we've used the same assumptions as last year, including the interest rate of 7.25. These are all based on an experience study we completed in 2022. And I went back and looked this morning. That experience study was based on experience from 16 to 2020. Okay, so a 5-year period there. We tend to do these every 3 to 5 years. And so since that last period that we looked at was the end of 2020, we've got another 5-year period now. It's due for an experience study. So I just put before you that it's probably time to think about doing that either this year or next year, reviewing the assumptions, just making sure everything we're valuing things with are as best as we can estimate, so that then the resulting liabilities, you can have confidence that it's the best guess that we have.
Well, why would we not want to do that as soon as possible?
I have no argument.
And that would affect the results of the plan that, of the actuarial study that you will perform in 2027, correct?
Correct.
So it seems to me that that's something that should be done immediately. Meaning now.
Yes,
This
now.
calendar year. Yes.
I would be in favor. of that.
Scott, what do you think? Or Levon, what do you think? Is, that would be a special study? Would that be included in our annual fee, or is that an additional?
It's an additional fee, but we've got it built into the contract, so it wouldn't be a problem.
I think if it's already built into the contract, that's gonna be a lot easier to accomplish. Than if we have to go out for procurement to get
Yes,
approval.
yes.
Yeah, that's something I'm happy to bring that to the team and get the ball rolling with that. So
I don't know if this requires a board vote or not, but I would like to ask for the board's agreement that we engage Foster and Foster to initiate that study this calendar year for, well, this calendar year. That's as far as that motion needs to go.
Yes, sir.
I'm not even sure I can make it as a motion because I don't think we have any authority to do so. But I am going to make it as a motion, and then somebody can reverse me later on if we don't. So, do you have, Aaron, you have,
When was the last one?
The last one was through using experience through the end of 2020. The study itself was completed in 2022. So this study, I would say, would take from experience from the beginning of 2021 through the end of 2025, and then be reflected in the 2027 valuation. That would be my approach.
And these studies, again, to look back over the last few years to see if the assumptions be mortality, retirement rate, payroll increases, all the assumptions were embedded in the model are reflective of what's actually been happening.
I second Bill's motion.
all those in favor?
Aye.
Unanimous. Okay, that is our endorsement.
Okay.
Now, I presume we can get started on it, but if somebody else actually has to approve it, you'll have to inform us who has to approve it.
Sure.
Okay. All right, go ahead.
No, that is all I have. There is more information in here in terms of showing data summaries and changes in assets and summarizing the plan provisions. Happy to answer any questions, but don't really think we need to walk through every page.
Agreed. Anything from the board?
No.
Levon, you're not an officially a board member, but do you have any suggestions, any additional questions you would like to pose?
not at this time.
All righty. Very good, Paul. Thank you so much.
Sir.
I guess. So now, we're gonna, ask ACG what they're gonna do about this.
Hey, I've got one question real quick. How often does the council contribute to the pension?
Well, Vaughn can correct me, but every payroll period, we budget and transfer money. And so there is a retirement fund essentially that we are taking the funds out of and paying retirees, right? So sometimes that fund is less than the current cash payout. And so then we have to draw down from Northern Trust to pay the bills. But sometimes that fund exceeds what the payout is, and then we put money into Northern Trust. Okay, so depending on what's going in, what's coming out, what the balances are, depends on whether we do a drawdown or we do a contribution update.
Okay.
It's best if we're not drawing down, because then we're not having to sell assets to pay current liabilities. And it's even better when we're putting money in.
I guess I think what I meant to ask, I could ask that better are there times where the company dumps a lump sum of money into the pension? Oh, we talked about that before. That happened in the past.
It was requested.
Okay,
by me.
Okay, this is.
Because I saw the huge divergence in the funded ratio of the civilian plan and the police plan. And this is when Stinger was still county executive. And so I made a recommendation to County Executive Stinger to make a lump sum, one-time lump sum payment of $5 million to the police plan, because you can distinguish where the money goes. So it would have been solely for the police plan. And that would have brought the two closer in balance with the anticipation over time. It would run pretty acceptably close and be actually much more favorable to the county. The recommendation was rejected. And it was rejected because, quote unquote, we don't have the money. And I would imagine if we made the same recommendation today, we would get a similar response, and probably preceded by the words, hell no. We don't have the money. Matter of fact, you recall the gentleman who was who presented the county financial situation several months ago. I don't recall his name, but do you recall that presentation?
Before the council, I mean.
No,
I presented it here.
budget director.
Budget director, yes.
Oh, Paul.
Yeah.
Paul.
You recall from his presentation that the county is very tight right now. It has liabilities. It takes some creativity to fund and consideration of deliberately increasing those liabilities. You have to, things are automatic, but deliberately increasing those liabilities just didn't seem to be realistic given that situation. And I think Paul, he came here actually as we were discussing the pros and cons of the cost of living adjustment as an ongoing task and challenge. And there's not enough money to do it. And as I recall from the presentation, the county has limited tax authorities by which it could raise the money. And you just can't get here from there without doing something substantially and major, probably requiring some sort of countywide issue, recommendation, proposition, I should say. That is what I recall. Oh, hell no, we won't go.
If it helps too, with just picturing the cash flow. So our plan, like most public pension plans, we kind of use the term, we're a mature plan in that, you know, we've more retirees, we're paying out more in benefits and contributions coming in, either from members or from the county. And so what that means is really ultimately the cash flow is really to make those contributions are used to make those benefit payments. And then we still need to draw, call it $3 million a month from the portfolio in addition to that, which is why the portfolio is there. It's by design. But that's some of the mechanics of the actual contributions of the actual.
Paul, at one time, I think I asked you how our funded ratio stands in comparison to the funded ratios of other Missouri plans, public plans. I believe I asked you to do that some time ago. Do you recall where we are?
No, I don't remember things as well as you do, Milt. So I will say I get this question a lot, not in regards to Missouri plans necessarily, but how does our funded ratio stack up against other people? And I caution people to not compare simply because a lot of it hinges on the assumptions you're using, right? If you're using an 8% assumption and I'm using a 6.5% interest rate assumption, my liability is going to be a lot higher, but my 70% is a lot more realistic than your 8% might be. Okay. Realistic might not be the right term, but you get what I'm saying. It's just, you could both be 70%, but if my interest rate's a lot higher than yours, then you're a lot on better footing than I likely am. Okay. So you are at 7.25. Your interest rate's a little higher than maybe the national average would be, but we're talking 25 basis points. It's not huge. You're a little higher in that regard, but I would say your funded status is a little lower than normally I'd see too. So you're not above average. Let's put it that way.
But also the benefit multiplier could be different.
Oh, absolutely.
Because the benefit multiplier for Plan A is different than what it is for Plan B. Plan B is a little more generous, and for policy decisions that was made. But Plan B has a more beneficial multiplier to it, which I would think would impact the overall funding ability. Because you have a higher benefit value out of that, right?
Yeah, but when you're comparing it to other people, I don't see how that really factors in.
Well, if their benefit isn't as high, if their multiplier is.
Well, they have to put in less money, but a funded ratio is just what's my liability versus the assets I've set aside. So it sort of neutralizes the benefit. If I
Okay.
decide to give a higher benefit, then I decide to give more contributions as well.
Now, the next time we think through and officially adopt our target return, 7.25 currently, it could be 7.5, it could be 7, it could be someplace in that range.
Mhm.
The next time would be in January, in the context of ACG's asset class projections for the future, for the intermediate to long-term future, as well as their specific projection for our asset allocation as currently it exists. So we'll have an opportunity in January to reassess what is realistic, and 7.25 may still be realistic. But we'll have that opportunity in January to reassess that and reaffirm it or change it, and then communicate that to Paul for incorporation into the actuarial report for next calendar year.
Mhm.
Actually, the actuarial report for 2026, which would be published in 2027.
Yes, sir.
Okay. Nothing further, Paul?
Yes, sir.
Right. I know Peppy just joined, but I don't know if she's heard enough to have a question. But if Peppy, I'm gonna stop for a minute and just let us know if you have a question.
I did have a question. I had been on, I've tried 6 different ways to get on and was muted the whole time when Paul was talking. And so I don't
Oh, good.
remember what the question was. I know we were talking about the percentage increase raise that employees got. And does that, I'm not sure it's the right question at this point. Just pass me by. I'll go back on mute.
Are you talking about that 20.5% number?
What was the 20.5%?
Well, then you didn't hear that part. I was trying to interpret what your question was or could have been. And when you said the increase in compensation for employees, I thought I heard you say, and I was wondering, is that the
Yeah.
20% number?
I thought it was a 16% increase, but it doesn't matter.
Well,
I don't know. I don't
I don't
remember. His
know.
contribution went up 13 or 15%, whatever we said, but I don't remember a 16%.
Okay, don't worry about it.
If it comes to you, Peppy, let me know. I'd be happy to answer it.
No, I'm
Yeah.
sure.
Peppy Sharik isn't here either.
Okay.
So we can always ask, when both of you are here, we can always ask Paul to give another abbreviated presentation
Happy
to
to.
bring you both up to speed, because you should be up to speed. It's terribly important stuff. So
Yeah.
we can do at a later meeting.
That probably would be helpful because I
Okay.
couldn't see the slides that you were working off of.
Okay, fine, we will do that. All
Thank
right,
you.
all right. Very good. ACG will lead us through the next part, which is how they're gonna make up the difference.
Yeah, and really talk about, our performance, our portfolio. I do want to spend some time on the market first. And so again, what Paul is talking about sort of is very important as we look at our, actuarial valuation. We're smoothing those returns, as he said, over a 40-year basis. And really certainly a lot led by 22, and I actually will show that. But then where we've been over the last few years too. And so just to put in perspective, if our actuarial value of assets, that smooth number, as Paul said, was about 905 million. Where we sit at the end of April, 999 million. And actually, if, we don't have our
999.
999.
You couldn't make it even bigger.
I was just gonna say, that's as of April, sitting here today, May 21st, are we at? I'm guessing that's over $1 billion.
Yes.
In the portfolio. So certainly it's a lot, volatility cuts both ways, to the positive and to negative. And so I think hitting that and reminding us of all this is good to put in perspective. So if you have my books in
I'm
front of
going to
you,
repeat what I said before, and I do want this to be in the record, but I don't want anyone else to take the blame for it. What the county council has done in freezing appointments to this board, to me, is unconscionable. We've got $1 billion here. This is not play money. And this is one of the few organs of the county government that actually makes money for the county. We ought to have the flexibility to have all the best investment minds we can find in St. Louis County sitting at this table. And to have even one opening is, to me, unconscionable. And you can quote Milt Wilkins on that. I don't ascribe that to anybody else on the board. And if the county council wants to fire me, that's fine. I can sacrifice $100 a month.
all right. With that, page number 5 of the ACG materials. And so as we talk about what's happened in the market performance, it's ultimately been very, very strong, but with quite a bit of volatility. And so let's also keep in mind, so we're sitting here, through the 1.5 quarters of 26, 25 was very positive in terms of returns. International equities were up
Kenny.
about, yes, Chave.
Excuse me, can you flip the deck to page 5 if that's what you're addressing?
Yes, we can do
Thank
that.
you.
Rachel,
Thank you
yeah,
much.
no problem. Thank you. I'll give you the page number. So again, 25 very strong. International equities up about 30%. US is kind of up 15. This kind of paradigm here shows the returns we've had so far in 26, and it's been definitely, even though it's been 4 months, quite a period. Right, so coming off of the strong 25, you see those light blue numbers in terms of returns. Those were January and February combined. And then, of course, we all know what's happened, grabbed the headlines, the war in the Middle East with Iran. You can see that really started at the end of February. You see that big pullback. That's what the dark blue lines is. These are the areas where we're invested, equities and fixed income there on the right. Tremendous rebound, really recapturing all of that in the month of April. That's what we'll show with our performance report. And you see this yellow year to date ultimately is somewhat as crazy and as volatile as 26 has been, where we sit through the first 4 months of the year. International markets, again, doing quite strong, particularly emerging markets up almost 15%. But you can see US small cap companies, large cap as well, up about 5-6% so far. Certainly been a strong environment. I am going to hit on where some of these returns are coming from within that dynamic. But I want to make the point, and I think it's really important, given everything Paul just said, but the volatility that has happened this year, it always feels like this is uncommon. It's not. Volatility happens all the time. So if you flip to the next page, page 6, this is a chart I always like to bring back at least once or twice a year as a reminder of the volatility we experience. So what we're looking at here, this is the S&P 500. It's a proxy for equity investing. And all these blue lines at the top of the page, these bars, this is what the annual return was of the S&P over the last, I think it's 42 years. You can see pretty much certainly strong returns across the board and mostly positive. I calculated one time, I think it's like 82% of the years equities have made money. They go up more than they don't. But what's important, so, is actually that light blue dots and that red dashed line. Those light blue dots show the biggest drawdown or loss at any one point in time during every one of these 42 years.
That's very helpful, by the way.
And the average of all of those is that red dash line. So we got as strong as equity markets have been over time, up over 80% of the time, certainly many years in the 20s, 30%. On average, the market's been down 14%. right? Certainly last year, great example of that. We were down 19 at one point last year, finished the year up 17. So again, there's a lot of volatility with this. That's kind of goes back to why there's smoothing in the actuarial valuation, why that is helpful from a contribution standpoint, but certainly it's important to keep in mind with what's going on. Certainly the volatility this year been much around the conflict in the Middle East, really having to do with, certainly war is always a fear, but energy prices, right? Energy prices continue to go up. We all know that. We're all feeling that. Companies are feeling that. So as it relates to equity prices, that's what's driven certainly the big drop in March, but then the corresponding rebound in April and through today. With that, one thing that's really changed, if you flip to page 8, so we're actually looking at the bond market here on page 8. So I showed you equity market returns and bond returns, but equity market returns earlier saw a big drop in March, a rebound in April. So actually, if you sit here year to date, we're had a good year so far, right? A big rebound. One thing in the top of this graph, what we're looking, we call this credit spreads. So what does credit spread mean? It means for corporate bonds, what interest rate do they have to pay that's higher than the U.S. Treasury? And when you look at it, our managers look at it on a bond by bond basis to see what's attractive. When you look at it in an industry perspective, what this is telling you is how risky does the market think the world is today? Higher credit spreads mean investors need a higher yield in order to loan money. If they need a higher yield, it means they're worried about, economic activity. But not to go through the numbers, but you can see both, whether from a high yield or investment grade corporate standpoint at the top, we're below historical averages. Credit spreads really in this environment haven't moved that much. So ultimately the market continues to think we're at a healthy space. What has moved is the level of interest rates. And that's at the bottom of the page. I'll put it in, going into really in February, the market expected the Fed was going to cut rates by 50 basis points this year. Now the expectation is the Fed is going to raise interest rates by 1% in 2026.
We may have a new director of the Federal Reserve yet.
No.
Another one.
Yeah. And that's where you can kind of see at the bottom here, these dashed lines in the two graphs. On the left is the expectation for the federal funds rate, what the Fed sets. That dashed line is the end of February, right when the conflict started. You can see a sharp spike up. And on the right-hand side, what you see are yields of the U.S. Treasuries in light blue, but it's other governments there in colors. And you can see certainly a drift to the top. So what does this mean? Expectations or interest rates are going to stay higher. Ultimately, this will probably have an impact on the equity market. It's more expensive to borrow. But really for us as an investor, right, we're trying to get 7.25%. Our fixed income portfolio, the 10-year U.S. Treasury is at 4.5% right now. Right, our managers are able to borrow money, loan money at 5.5%. That's the return we're going to get from our bond portfolio. So you talk about how are we going to help kind of drive returns going forward. Earning more money from fixed income is going to continue to be a benefit for us going forward. Another key theme, just the next 2 pages, right? So interest rates are moving higher. We've had a lot of volatility this year. Performance has been really good, but it's continued to be led by AI technology focused companies. Returns are continuing to pop off and really defy valuations. What I mean by that is stock prices are rising to the point that certainly outpace even what expected earnings are coming from these companies. And I'll hit on that in a minute. But certainly this has continued to be led by the large cap area, the Magnificent Seven, which we've talked about before, Google, Tesla, Meta, NVIDIA. That top of page 9, this is that PE valuation, which we've talked a lot about in here, right? That's how expensive these areas of the market are. And really the higher the PE, the more the market is paying on a per earnings multiple to own these companies. You can see the Mag 7 certainly continues to be off the charts, leading the way and certainly pulling the large cap S&P 500 with it. The other areas where we're invested, U.S. small caps, international markets, tend to be much more attractively priced, even with these stronger returns they've had so far. And really, just to break this down, page 10, we call this spaghetti chart at ACG because it kind of looks like that. But really, the point of this is, first off, you go to the right-hand side of the page. and just that comment that is pulled out there. The largest companies, Amazon, Meta, Microsoft, they've committed to spend trillions of dollars just over the next few years in their development of AI, in data centers, in research. There's been a lot of excitement from the market on this, of what AI can do, so it's pushed investors to these stocks. At some point, there's got to be revenues to support the spending that they're making. It's kind of in the blue chart above, we just singled out OpenAI. OpenAI is committed to spend just themselves $1 trillion over the next few years. They're currently bringing in 13 billion in revenue. So this year they're making 13 billion, and they're going to spend $1 trillion over the next 4 years. Right? The expectation is they can turn that into revenues, but ultimately at some point, with all of these companies spending this much money, not all of them are going to be able to pull in that amount of revenue to support the spending that they make. Some will for sure. And where there is some concern, that goes back to this spaghetti graph here. These are all these different companies. And basically what we're showing is the purchases, buying from each, how they're supporting each other. It's almost a little bit like a domino potential impact there. So there certainly continues to be concern in the marketplace. There will be winners out of this. And then certainly some returns that we've already benefited from and continue to benefit from. But ultimately, there's certainly some high valuations in this area, which again is why, as a board, as a portfolio, we still have a large exposure to this area of the market, but less so than many of our other peers because of the high rich valuations within this space.
And this is a good tee up to the next page, but everything that he just described is how you build your portfolio really matters. So where I'm going with this is when you look at the active community, right? If they did well and they outperformed in this market environment, which has been driven by this web, and I apologize, I'm the one who authored this page. It's supposed to look busy for a reason. That's the point we're trying to make, is the cross-pollination, it's all of these things. But where I'm going here is when you look at the active community, if you tell me how much they had invested in AI and the web around AI, I'll tell you that they outperformed, because this is really the only thing that's been driving the market. But that's kind of the benefit of active management over the long term. They own less of this stuff, so you'll see underperformance, but that's a protection mechanism if it does roll over. Your passive exposure is going to own this kind of stuff blindly. They're just going to follow the market, right? So that combination, like you have in large cap, going in small cap, things like that, helps provide a buffer no matter which way the market goes. Which is a pretty good segue to the next page and the dynamics we've been seeing in small cap.
Can I ask you something? Is there any kind of historical analogy for this situation? Anything that you can look back on in time?
Yeah.
that had this?
Yeah, I mean, the magnitude is tech bubble. But what's different this time around,
When you say tech bubble, you're talking.
99, 2000,
Okay.
right? So
Yeah.
think of,
Yeah.
and that, if you can go back to that time frame, it was the internet. So, and the question back then was, all right, this internet, it's a novel idea, but how do you make money off of it? Turns out it was advertising on your webpage. We didn't know that at the time, right? That same dynamic is going on with AI. AI is just a thing. How do you make money off of it? Internet is just a thing. How do you make money off of it? And that's where this arms race of spending is going on. OpenAI started out as a not-for-profit, and it quickly turned into a for-profit company. Some headlines just were made recently on that. I think that's what it is the spend. Think about it in your own lives. We can go buy a 75-inch TV for $200 now, right? 5 years ago, 3 years ago, 2 years ago, it was a couple $1,000. This $1 trillion that's being spent today is the juice worth the squeeze 3 years from now. So that's where active management comes in, is to try to discriminate amongst these to figure out who's going to be the winner.
However, I don't think that the internet revolution that occurred in the late 1990s, early 2000s, had the capital investment requirements of what we're talking about today.
It's very different, but I would also say maybe another difference is the analogy drawing the two together is the internet was a thing. AI is a thing. Now everybody's trying to figure out how to make money off of those things.
I agree with that.
Yeah.
I just think the magnitude of capital investment required to do it seems to be orders of magnitude higher now than it was even on a relative basis back in 2000. But I'm speaking without numbers in front.
There's a lot of private equity out there that's helping support a lot of all of this that you see in here
Yeah.
is the cross pollination that Finney was just talking about. They're funding themselves.
But the internet was revolutionary and changed the world. This is going to be revolutionary and change the world as well.
And the good news is your portfolio will benefit either way.
Yep.
No matter which direction it goes, that's why it's designed. There may be relative underperformance for some active managers that are not fully capturing this kind of thing, but you got passive to offset that. So that's what I mean about structure. No matter which way the market goes, you're gonna benefit.
And it's a great question, Paul, because certainly the dot-com bubble comes up with this and kind of two things. So the big crash, which I think, Milton, this is what you're getting to from the AI, or excuse me, from the tech bubble, the dot-com bubble years ago, those companies didn't have revenues, right? They didn't really have a business. People just wanted because they had this internet. Where these companies on here certainly are big. They're not going out of business. But I'm gonna 2 points to this. First off is what could be hit certainly is their stock price and their overly valued. And a great example of this is just yesterday. So NVIDIA released their quarterly earnings like all public companies do. Their revenues from the same quarter last year were up 80%. 80%. They also did a tremendous amount of stock buybacks, which is really fantastic for a stock price. You take a lot of, available out there. They went down. They're actually trading lower afterwards, not tremendously, but lower. That speaks to the expectations and that the market is building into these really lofty valuations, right? And so that's some of the concern with these companies in the large cap space of just being overvalued and not going to be able to generate the revenues with what they're spending. Now, we're actually seeing a similar dynamic where it's maybe more related to the analogy of the tech bubble at page 11 is on the small cap side. Right, so the small cap area of our portfolio, these are smaller companies in terms of size. We've seen a tremendous growth in terms of returns over the last year in this space to a lot of newer startup companies who are within this ecosystem supporting the bigger players. And what we have seen is a tremendous growth in returns of their stock price, more so for companies who either don't even have any revenues yet or aren't turning a profit. And that's what the graph on page 11 is showing. Is basically we divided and there, 6 different benchmarks, small caps, mid cap, growth value, et cetera. The story's the same across the board. That green bar to the bottom that's how much we're saying earners underperform, how much companies that aren't turning a profit, how much their stock price beats companies that are turning a profit in their respective spaces. And you can see it's 15, 16, 20% in different areas. So this is actually maybe more similar to the dot-com bubble where these newer companies aren't turning a profit yet, but are kind of within the ecosystem of AI supporting it, where they're building data centers, et cetera. Money has flowed to buy their stock prices, but ultimately really don't think that valuation is there. So, those are kind of just, again, key themes of the market. First and foremost, it's been a strong year in terms of returns. Show our portfolio, our performance has been strong. We've seen some broadening out from the international, which we haven't seen as much up until really last year, which has been beneficial for us. Ultimately, though, really what's both international, but especially US, continue to think be overvaluation in these kind of tech-focused areas where the fundamentals might not support that. But that's why we have, as Craig was saying, a diversified portfolio with managers. And then also just on the fixed income side, interest rates, we do think are going to remain high, which ultimately will be a benefit for us as our managers are purchasing bonds. That makes sense?
Mm-hmm.
So why don't we flip to look at our portfolio? Page 28 is the second tab. And so just a kind of real quick of where we are. This is as of March 31st. Again, I already told you as of April 30th, we're at $999 million in the portfolio. But you can see where we've been. We started the year at 963. So certainly we've, the first quarter, with what happened in March, ended up being down from an investment return. But that kind of second line, that net additions, this is money coming in and out of the portfolio. This is, Aaron, to your question earlier, this is really benefit payments. What we're pulling out from the portfolio to pay our beneficiaries over time. It's about $30 to $35 million each year. And so you go back to where we were a year ago, March 31st of 25, with 864 million in the portfolio, took out just about that 35 million, and our investments made about 110 million. So that's kind of marrying with what Paul is talking about, what our investment portfolio is here to do. We know we're going to get money pulled out, but ultimately able to help grow and make those returns. Page 29, just our portfolio from an allocation standpoint. Really, the big thing is, as Milt alluded to, every January, we want to make sure we're reaffirming our strategic asset allocation, how we're allocated in a line. And that fourth column, that over underweight, we're kind of right on top of where we want to be from the big picture, equity, fixed income, and real estate. Page 30, looking at our returns, and this I think kind of goes with a little bit, very much of what Paul just went through with kind of where we are and how we've gotten here. On the right-hand side of the page, we're showing our returns for the 3 months, 1 year, 3, 5, 10. Comparing how we've done versus our policy index, how we've done versus other peers. So keep in mind, we compare ourselves with a universe. It's about 200 public pension plans in the US that are between 100 million and $1 billion. We might be graduating and have a new universe here soon, but this is the group we've compared ourselves to. You can see for the 3 months, the first quarter, we were down slightly, as I just showed, down 1.3. For the last 12 months, our portfolio is up 13%. We're actually behind our policy index, really driven by most of our managers aren't owning as much as that AI, non-earning, non-profitable companies as the index is. But even with that underperforming our policy index, you can see we rank in the 41st percentile. So still the top half of our public plan universe over the last 12 months. You can see 3-year return up over 9%. 5-year, that's the one that's below our actuarial target of 5%. As Paul just talked about, the big reason why our actuarial valuation is what it is, because it's that 4-year smoothing, including 2022. And that's certainly within the 5-year realm. But you can see though, for the last 10 years, certainly above that, up over 8%, for the most part in line with our policy index, and in line with our peers, kind of ranking right within that midpoint. And I think it's helpful to look at that the bottom left graph and really kind of what's been driving some of these returns. So these are the last 10 calendar years, right? From 2016 to 25.
Where are you?
On the bottom left of page 30. So how our portfolio return in light blue, our policy index in dark blue, and then that median in the peer group. So last year, 25, kind of talked about, it was a great year overall. It was a great year for us. We were up over 14%. We ranked in the 30th percentile versus our peer group, right? A lot of that driven by having more diversification within international in particular, really helped drive in some return. But again, underperformed our policy index for all really the comments that I just talked about, the high valuations, and the high of US large cap tech as well as in small cap. 2024 as well, you can see, our portfolio over our target rate, 7.8%, underperforming our peers. And why was that in 24? Because that's when US large cap did the best. We really saw the Mag 7 run in 2024, and we just had less exposure to that. 2022, this is the return that Paul was talking about. This is kind of the last year that's going to be on our actuarial valuation before it rolls off. Certainly everyone had a down year. We certainly had a down year with that. But you can see the really strong returns leading up to that in 21 and 20, both from an absolute perspective as well as pretty strong returns versus both our peers and our policy index. So again, just speaking to that volatility slide I showed you in the beginning about how volatile equities can be, certainly that plays a part in terms of performance of the overall portfolios, even relative to our policy and peers over time. But again, you look at the longer time period, up over 8% kind of right in there with our peers, even with some of this recent headwinds we're facing with high valuations and particularly large cap outperformance in 24 and 23. Overall, we think our portfolio is well positioned to kind of weather the storm of and be very well diversified.
Does everybody understand that that's a key point from Paul? That 4-year window that he was just describing for investment returns are those last 4 years there, and that this is exactly the reason why you would want to smooth it. So you don't have that funded status volatility of being whipsawed from 22 to 23 because the investment returns have been kind of 2x in 23, 24, and 25. The actuarial, the 7.25, right? So that's exactly why you would want to smooth. And that's also the green shoot that he's talking about whenever 2022 rolls over. We don't know what 2026 is going to be, right? But that 2022 is going to roll over and be replaced with 2026 the next time you see him.
With that, maybe so these are kind of our overall ranks, the returns. I think it actually worthwhile to jump to our April 30 performance report.
I agree.
Given just how much has happened.
Let me say this, I agree for the following reason. Neither Pepe's on the phone, because she won't be not here in person, of course, and Shariq are not here. I would like for both of them to be in the meeting when we talk about individual managers, because there's a lot of wisdom there. And so let's just go on, let's not talk about the individual manager and material, which is all very, very helpful. But it's so helpful that I'd like for the entire board to be represented.
Makes sense.
Okay,
So with that, so it's the third tab. We can just go to page 110. So as I have said, started the year at 960, as of the end of April, that 999.798, a lot of high numbers there. Total value of the portfolio as of April 30th. So far through yesterday of March, markets are positive here in May. So again, I'm guessing we're over $1 billion now within our portfolio. You can see where the returns have come. So certainly that strong rebound in the month of April, we're up over 6.5%. And you can see year to date, right? So first 4 months up over 5%, kind of certainly right in line with our benchmark. For the 1 year, up 19.5%. You can see a little bit behind our policy index. Again, a lot of it having to come from just those high valuations in particular areas. I do want to make the point too, we talk a lot about managers, but also try to bring back, not only our asset allocation, sub-asset allocation. What I mean by that is how much we own of large cap versus small versus international. So going down the page here, if you look at our overall US equity composite, so that's our both large cap managers and small cap managers. And we compare ourselves to the Russell 3000, which is a universe of large and small, heavily dominated and weighted by large cap within that area. So you can see year to date, we're up 675, a US equity portfolio, outperforming the Russell 3 by just under 1% at 91 basis points. Even though you can see within large cap and small cap, a little bit split in over and underperformance versus their respective groups. And you can see for the 1 year, our US equity portfolio up over 30%, certainly very strong. We're just a little bit behind the policy index, the Russell 3000 by 65 basis points. But as you break that down, you can see actually about 4% underperformance within large cap, right? Why is that? Because the index is up 30%. We have 60% of that portfolio there is passive, so we're getting that exposure to the mega caps, but we also diversify with our 2 active managers on the side who have trailed, not surprisingly, in a big up market. But look at that strong return from small cap, right? The benchmark over the last year is up 44%. Our manager, I think, did a great job being right up to that over the past year. And that higher weight we had to small cap has really benefited our portfolio and more than outperformed some of that active manager difference within the large cap space. You can see within international managers, certainly absolute returns, again, continuing to remain strong. Just so far this year, our 2 developed managers, WCM, Silchester, up almost 6%. a little bit below the benchmark there. We have seen a strong rebound from William Blair. Kind of so far this year, up over 10% in terms of returns. And then also I mentioned emerging markets, right? Acadian, our manager, has really been strong for us over the last several years. But this is an area of 46% return over the last 12 months for emerging markets. Up over 15, almost 16% year to date. This is an area that certainly over the last 3, 4, 5 years has lagged, especially relative to US large cap, but an area where we've certainly seen a tremendous swing in terms of returns recently. So why we have that diversification in our portfolio.
Just to add a comment there to talk about the market in general, and you asked about what's different this time around and what's maybe changing. I think emerging markets is a really good example. When you historically, 15 years ago, when emerging markets became an asset class, you thought of emerging markets as being the warehouse to the world. But that warehouse to the world was oil, it's gold, it was silver, it was nickel, it was the miners of the world. That's what we meant by the warehouse to the world. Well, fast forward to today, the reason why that number is so high, they're the warehouse to the world, but in terms of AI. They're the ones who make the chips. They're the ones who have created the foundries and all of the connectivity that goes along with it. So they become the warehouse to the world from like a maybe old economy to the warehouse to the world of the new economy. So they're not immune to this AI. In fact, they're strongly benefiting from it. They're creating the widgets. They said, the gold miners, you made the most money when you sold them the shovels, the picks. That's emerging markets today.
So happy to take this conversation where everyone kind of wants to go, Milt. I know you said, save some of the, maybe in the deeper conversations, still Sharik, Pepe are here. But, ultimately, as we look at this portfolio at the very top level, 1-3-year returns, especially the 1 year, very strongly ahead of that 7.25 we're looking for. As we look versus our policy index, again, it's not surprising the higher the absolute return, the more we're going to trail a benchmark, right? Given where we have active management, which is most of the portfolio, we have a big chunk of passive within US large cap as of now. I know we're adding a little bit more passive, but ultimately active managers tend to be valuation focused. And so really when you see these big screaming runs in terms of returns, a lot of times active managers are going to trail in that time period. But so it's not surprisingly in a year where we're up 19.5%, we're trailing by 2.5 versus our policy. We would rather have it this way than if the market was flipped and we were down 19%, but then also trailing over that time period.
Anything further?
No, happy to answer any question.
Questions from the board? Pepe, you included, of course.
Not at the moment, thank you.
All righty. Anyone here? Okay, fine. And that'll be all for this particular item number 6 on our agenda. Going to item number 7, the implementation status of previously approved new investment managers. John, would you like to tell us what is and is not happening?
Sure. We'll start with the one that's completed, at least from our standpoint, as the portfolio advisors. That was confirmed with ACG. Marcy's been very helpful, so I appreciate working with her. The account with BlackRock, we do have 2 agreements that our office is reviewing, and we're working with their legal counsel. So hopefully that'll be wrapped up by the next meeting, hopefully.
Now, BlackRock has already been approved by the county council.
That's correct. So
So you're now the critical path.
correct. And we're on it. The last account, Northern Trust, and we'll talk a little bit about the process. I didn't realize that the retirement office was waiting for our office's approval on the letter to go to Dr. Page's office. And so we discussed it yesterday, and that letter, I believe, was signed by Milt this morning, or will be signed.
Will be signed.
And go to Dr. Page's office for consideration. So hopefully we'll be able to move on that. We do have the agreements and the information, and we'll begin reviewing those. So upon entry of the order by the council, we'll be.
All right, now let me ask a question.
Yeah.
After I sign the letter and it goes to Dr. Page's office,
Correct.
who's going to follow up and make certain that somebody in Dr. Page's office actually gets Dr. Page to sign the recommendation to go to the county council?
I think that would be up to Rachel and Becky.
Okay.
But the county executive's office, to make sure.
Becky and I've had the experience recently where things just fell between the cracks. No one knew who was doing what. And it held us back pretty substantially.
Yeah.
One of the managers.
So thank you for the opportunity to help kind of clarify the process. And this is countywide. What happens is that proposals are a request for legislation are considered by the individual county departments. They're brought to the leadership, and the leadership decides when to send that request to the county executive's office.
Okay, assuming I can sign this morning, we can send it to the county executive's office presumably tomorrow. Right?
I thought Rachel mentioned that she may even be able to deliver it today.
That'd be marvelous. Now, what is the earliest in your mind the county council can get it and approve it?
So, we talked to Snehan, the county executive's office yesterday, and, I had to sign the letter today. I am emailing it to her right after this board meeting to, be delivered immediately. They will take a look at it, she said. So she said as soon as possible as I can get it to her. So I am going to send it to her right after the meeting.
As a practical matter, they don't do anything to the letter. They don't make a decision on the manager or anything. I mean, it just has, as a matter of process, it goes through them, but they don't do anything with it. So I'm trying to think, when could the county council actually get it and vote on it? Does the county council have certain meetings reserved for approval of things like this? Or can it be done at any meeting? Because the council meets what, once a week?
Yeah, every Tuesday.
Yeah.
Monday's a holiday, so.
And there was a notice that their agenda will be locked at some time. I don't know if it's today or tomorrow, but there will be no add-ons to the Tuesday agenda.
Okay, fine. So the earliest, as far as we can see, would be the 2 Tuesdays from now.
I mean, I don't know. Logically, yes, probably.
All right, fine. Because then we have to give notice and so on and so forth. Okay,
So the requests go through the department's leadership, they go to county executive's office. If there are legal questions, then they may come to our office for research and consideration. And then the county executive's office will decide when to send it to council for their review. So in the future, you don't have to wait for our office to approve requests for legislation. They can
goes to county executive and then directly to,
through the Rachel and
Rachel and
Becky's
and then directly to the county council. And then after the county council approves it, it does come back to your office, correct?
Yeah.
And that's when you
Well,
go,
if there are agreements for legal review, which there usually are. So we try and work to get those at least on deck. So when the order is entered by the council, we can have the appropriate people sign and implement whatever action you've requested, and the council approves.
this is Northern Trust we're talking about.
Correct.
What is the, does Northern Trust have a deadline, monthly deadline by which, or it can be done at any time?
It's like
Separate account or commingled trust?
commingled.
They can take it at any time.
Mhm.
Like,
Yes,
that might have to be in by the,
No, that's for the US small cap, they can take that at any time. For the BlackRock funding, which we're close to. BlackRock will be able to take it anytime, but we will be moving money from Silchester to our international manager. And they have monthly liquidity, but also if you remember, there is a cost that the investor pays to get in and get out for some commissions. What Silchester is able to do is basically net, for instance, or we're drawing from them and someone's adding, they can kind of net that to save us. And so we're gonna work with them and like, we might break this up over 2 months is what I'm saying, to help save some costs there. As well as then we're currently overweight emerging markets with Acadian, part of that by strong returns. And so we use some of that capital from there to rebalance. So we'll be able to, once everything's kind of, I's are dotted and T's are crossed, be able to kind of finalize that rebalancing and share.
Whether it's catering or fixed income, managers, use whatever you need to use to make this thing happen. Please.
Yes.
Okay. Anything further?
No, sir.
All righty. Is there any other business other than one item that we have to discuss in closed session? Any other business? In the closed session, take about 25 seconds. All right. Thank you, guys. Thank you very much.
Thanks, appreciate you. Yeah, see you.
Hold on. Sit still. There are visitor comments. Are there any visitor comments Marion would like to make? And I'll have our gentleman here to help answer any questions that you might have.
To be able to do that.
Marion, you have any questions? Comments? You're on mute. Okay, we're gonna press on. Yes, thank you.
These guys will start talking about Memorial Day weekend. We'll see it happen Memorial Day weekend. We'll see.
Okay, I'd like to have a motion to procedurally, I think it's simply a motion to move into closed session. We don't move.
Second,
All righty. All in favor?
Roll call.
Oh,
Roll
that's
call
right.
vote.
We have a roll call of 4 people, 5 people, 4 people. 4, 1, 2, 3. Well, 5 actually, since Pepe is on the line. So let's have a quick roll call. Since I can see 4 of the 5.
Aye.
Pepe,
yes.
Paul,
Aye.
Sharif, Captain Schaefer.
Yes.
Mel.
I'm here.
Present.
Okay, fine. Now we're in closed.
I just lost the audio.
the tastiest cupcakes we've served at a board meeting. So it's unfortunately, you're out of town at the moment. May I have a motion to adjourn the meeting?
Second.
All in favor? Aye.
Aye.
Meeting adjourned. Thank you so much.
Thank you. No,
10:30. That's right.
not too bad, not bad.
Put that in the meeting.
Thank you.